Hey everyone, welcome back to Corporate Decoder, the place where we dissect financial reports to bring you the real story behind the numbers. Today we are diving deep into International Media Acquisition Corp, or IN. This filing could be quite an interesting one because it feels like a company at a crossroads. Did they find their merger target or are they still searching? Let's find out. Before we jump in, if you enjoy these straightforward financial breakdowns and want to stay ahead of the curve, make sure you are subscribed and hey, join our Discord community linked in the description below. We are building something special there. Alright, so we are looking at a quarterly report for the period ending the 30th of September 2025. This is basically a check-in on the company's financial health and what has been happening over the last few months. They are reporting as an emerging growth company and also a smaller reporting company, which means they have a bit of flexibility in what and how they report. It also tells us they are likely in the early stages of their business journey. Let's kick things off with the balance sheet. This is like a snapshot of what the company owns and what it owes at a specific point in time. Looking at the 30th of September 2025 compared to the 31st of March 2025, we see some interesting movements. Total assets have dipped slightly from about $3.6 million to around $3.5 million. On the liability side, accounts payable and accrued expenses are sitting at over $951,000 at the end of September. Pretty consistent with the previous period, but a couple of lines stand out. We have promissory notes JC Unify increasing from about $2.6 million to almost $3 million. This means they've taken on more debt from this particular lender. Also, their total liabilities are quite high at over $15.2 million, which is a significant chunk compared to their total assets. Now, here is something very crucial for a company like this. Common stock subject to possible redemption stands at over $3.3 million. This represents shares that can be redeemed by shareholders. The fact that it is stated like this means these shares are not considered permanent equity and are essentially treated as a potential liability if shareholders decide to cash them in. And then we hit the dreaded accumulated deficit. At the 30th of September 2025, it's over negative $15 million. This means the company has spent more money than it has earned since it started. For a blank check company, this is to be expected as they are designed to find a business to merge with, and that takes time and money. Moving on to the statements of operations, this is where we see how much money they made or lost over a period. For the 3 months ended the 30th of September 2025, they reported a net loss of close to $97,000. For the 6 months ended the 30th of September 2025, the net loss is around $217,000. This is really just them spending money on administrative costs, franchise taxes, and dealing with the fair value of their warrants, which is a complex accounting item. The silver lining here is the interest and dividend income on investments held in the trust account. For the 6 months ended the 30th of September 2025, this income was about $69,000. This is basically the money they earn from the funds they have set aside. It is not operational revenue, but it does help offset some of the costs. The shares outstanding have changed a little bit, but what is important here is the net loss per common share. For the 6 months ended the 30th of September 2025, it is a loss of about 3 cents per S-share. For a company that has not yet completed its business combination, this is not unusual. This statement shows how the equity section of the balance sheet has changed. For the 6 months ended the 30th of September 2025, we see the net loss impacting the accumulated deficit, making it more negative. Essentially, any losses the company incurs directly increase this deficit. Now let's look at cash flow. This tells us where the company's cash is coming from and where it is going. For the 6 months ended the 30th of September 2025, net cash used in operating activities was a negative $474,000. This is consistent with their losses. They are spending more cash than they are bringing in from operations, which is typical for a SPAC. In investing activities, they deposited about $12,000 into the trust account, which is a very small amount. However, they also withdrew $40,000 from the trust account to pay franchise taxes. That is an interesting move. Financing activities show they provided about $205,000. This likely comes from loans or other forms of funding that are not related to operations. And the big number here is the cash at the end of the period. For the 6 months ended the 30th of September 2025, their cash balance is zero, that is right, zero cash. This is a massive red flag and points to their struggles with liquidity, which we will discuss more later. So what exactly is this company? International Media Acquisition Corp, or IMAQ, was formed to merge with another business. They have not yet started any real operations. Their income comes from interest on their trust account money. They underwent a fiscal year change and their initial public offering, or IPO, was in August 2021 worth $200 million. They also had a private placement at the same time, raising over $7 million from their prior sponsor content creation, Media LLC. Crucially, a massive chunk of that money, over $230 million, went into a trust account. This money is meant to fund the future business combination and is invested very conservatively in US government securities or money market funds. A key feature of these special purpose acquisition companies or SPACs is that public stockholders have the right to redeem their shares for cash if they don't like the deal, or if the company fails to find a merger partner in time. This is a big deal because if too many shareholders redeem their shares, the company might not have enough cash to complete the deal. These companies have a deadline to complete a business combination, usually around 18 months. IMAQ has extended this deadline multiple times with deposits into the trust account. They now aim to complete a merger by January 2027. They did try to merge with Reese Entertainment Holdings, but that deal fell through. This is a common occurrence for SPACs. Then there is a securities purchase agreement with JC Unify. This looks like a significant financial arrangement where the prior sponsor agreed to sell a large chunk of their shares to this buyer. They issued a promissory note to JC Unify for up to $1.3 million. This is essentially a loan. This note is convertible into units of the company, which means JC Unify could get shares of IMAQ instead of their money back. Most importantly, they have entered into a merger agreement with VCI Holdings Limited and Vietnam Biofuels Development Joint Stock Company. This is it. This is their target business combination. The deal is valued at a whopping $1 billion and will involve the company redomesticating, changing its jurisdiction, and then acquiring these companies. They also have a very large equity line of credit with White Lion Capital LLC for up to $300 million with an option to increase to $500 million. This is a significant commitment of potential funding. We can see here that numerous shareholders have redeemed their shares over time. For example, in January 2024, almost 1 million shares were redeemed. This is important because it reduces the amount of cash available in the trust account. This section is extremely serious. As of the 30th of September 2025, the company had no cash and a working capital deficit of over $7 million. Their accumulated deficit is over $15 million. The auditors state there is substantial doubt about their ability to continue as a going concern. This means there is a real risk the company might not make it. They mention the Inflation Reduction Act and a 1% excise tax on stock repurchases. Given their financial situation, this tax could add more pressure. This part is about the accounting rules they follow. They're an emerging growth company and can use some relaxed rules. They rely on estimates, which means actual results can differ. Their cash situation is highlighted as zero, and their investments in the trust account are where most of their assets are. Warrants are a bit tricky. Public warrants are treated as equity, but private warrants are treated as liabilities. This means changes in their value directly affect the company's profit or loss. For the 6 months ended the 30th of September 2025, they recorded a loss of about $5,500 related to the change in the fair value of these warrant liabilities. This reiterates that a large part of their stock is redeemable. They adjust the value of this stock constantly to reflect the redemption value. The IPO cost them over $15 million. This is a significant expense for a SPAC. We see a large chunk of this cost, over $13 million, reduced temporary equity. This section details the IPO. 20 million units were sold at $10 each, raising $200 million. Each unit had a stock, a right, and a warrant. Simultaneously, they sold private placement units to their sponsor, raising over $7 million. This is where we see all the dealings with the prior sponsor and lenders. There are founder shares, promissory notes, and various agreements. It shows a lot of related party activity, which is typical but needs careful watching. The total outstanding promissory notes to the prior sponsor are $2.4 million. Promissory notes to JC Unify are almost $3 million. This covers various agreements like the merger agreement, registration rights, and underwriting agreements. The deferred underwriting fee is a substantial $8.05 million payable only upon completion of a business combination. This explains the details of the warrants. They have millions of warrants outstanding, both public and private. Warrants give holders the right to buy stock at a certain price. If the stock price goes up, they can be very valuable. If not, they expire worthless. The company can call back these warrants for redemption under certain conditions. This section details the stock structure. They authorize preferred and common stock. The rights attached to the units, which entitle holders to a fraction of a share upon a business combination, are also described. Here they detail how they value certain financial instruments like the private warrants. They use complex models. The fair value of the warrant liability as of the 30th of September 2025 is about $23,900. IMAQ operates in a single segment. Their chief executive officer, chief financial officer, and chairman are the key decision makers. They focus on general and administrative expenses and interest earned from the trust account. This catches us up on anything that happened after the 30th of September 2025. They made a deposit for an extension in October 2025. This means they are still pushing the deadline. This is management's own explanation of the numbers. They reiterate their status as a blank check company looking for a business combination. They again stress the risks involved in issuing more shares or debt. They continue to make extension payments. This shows they are spending money just to buy more time. They acknowledge they have no operating revenue yet, and their activities are limited to finding a merger partner. The net loss for the 3 months ending the 30th of September 2025 was about $97,000, with more losses for the 6-month period totaling around $217,000. This is where the real picture emerges. They had no cash as of the 30th of September 2025 and a significant working capital deficit. They are highly dependent on their promissory notes. The report explicitly states there is substantial doubt about their ability to continue as a going concern. This is a very strong warning sign. They have no off-balance sheet arrangements, which is good. It means they are not hiding any major financial risks in separate entities. Here they list their commitments. The deferred underwriting fees are a big one. They also mention lock-up agreements for some parties which restrict them from selling shares for a period after a business combination. They are not involved in any material legal proceedings currently. As a smaller reporting company, they don't have to list new risk factors here, but they do reference their previous annual report. The key takeaway is that there are significant risks involved in their operations and their pursuit of a business combination. This lists all the supporting documents attached to the report. Now, for our assessment of International Media Acquisition Corp, this company is in a precarious position. They have significant accumulated deficits, very high liabilities relative to assets, and critically zero cash on hand as of their reporting date. The fact that their auditors have raised substantial doubt about their ability to continue as a going concern is a major red flag. Their proposed merger with VCI Holdings and Vietnam Biofuels is a huge deal valued at $1 billion. If this merger goes through, it could be a lifeline. However, the timeline is tight and the company's current financial state raises questions about their ability to even reach that closing date without running out of funds. The massive equity line of credit is a potential savior, but it comes with its own set of conditions and potential dilution for existing shareholders. The repeated extensions of their business combination deadline indicate a struggle to find and finalize a deal. While they have a target now, the path to completion is fraught with financial and operational risks. The high amount of redeemable shares also adds pressure, because if many shareholders choose to redeem their shares, the company could be left with insufficient capital to close the deal. In conclusion, IMAQ is a company betting everything on its upcoming business combination. The financial health is weak, and the going concern warning is serious. Success hinges entirely on the successful completion and funding of this merger. Any hiccup could lead to dissolution. Alright, that is our breakdown of International Media Acquisition Corp's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this merger will save them, or are the risks too great? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep financial dives. Don't forget to check out the Discord in the description. We are building some great discussions there. Thanks for watching, see you next time.